Dan Loeb is issuing a warning to the market. Traditional value investors who refuse to adapt to artificial intelligence are facing extinction. Loeb built Third Point into a $25 billion firm by starting with just $3 million in 1995, following the classic event-driven strategies of Joel Greenblatt. His early success came from the forensic study of cheap, inefficient companies, corporate spin-offs, and the dense 3-inch-thick bankruptcy filings of firms like Drexel Burnham Lambert. For decades, Wall Street considered this devotion to low-multiple, deep-value assets the most reliable way to allocate capital. But the evidence of the last decade shows a different reality. Sticking to those traditional metrics while avoiding technology led to persistent underperformance, effectively breaking the traditional value model. While investors traditionally scan government reports for unemployment or inflation figures, Loeb argues these numbers have become secondary signals. Today's market is dominated by geopolitics, specifically how international conflict and war determine the global price of oil. Alongside energy, the market now moves based on the scale of global AI infrastructure spending, a force that is compounding across every sector. To remain relevant, Third Point had to abandon its old analytical framework to account for these massive shifts in capital. Success in the modern economy now requires a deep understanding of global energy flows and the physical requirements of artificial intelligence. Loeb transitioned his strategy towards quality investing, focusing on companies that generate high returns on capital and maintain wide competitive moats. He analyzes the AI industry as a physical industrial supply chain, which can be mapped as a 3-tier tech stack. The base of this stack represents the power and energy infrastructure required to keep data centers running. Above the infrastructure are the semiconductors and hyperscalers. Loeb began backing this sector years ago, long before NVIDIA became the market's primary focus. At the top of the stack sit the foundation models and consumer applications, specifically the ecosystems being built by Anthropic and Elon Musk. Quality investing in this era depends on identifying exactly where a company's structural advantage sits within this specific technological hierarchy. Even in a tech-driven market, traditional value routes allow an investor to hunt for the fulcrum security, the specific point in a company's capital structure with the best risk-reward profile. When equity valuations for growth companies become too expensive, a flexible firm can pivot to investing in the company's debt instead. For example, during a period of market panic over Twitter, Loeb purchased the company's debt at a discount, securing a 12% yield while others fled. He applied the same logic to XAI, providing debt funding by assessing the firm's real-world enterprise value rather than waiting for positive cash flow. However, no strategy is perfect. Third Point admitted to a major failure during the FTX collapse, where they neglected basic due diligence, like verifying bank balances. Flexibility across the capital stack is a powerful tool, but it is useless if an investor ignores foundational research. This visualization shows the speed at which AI now ingests data. If machines can automate financial analysis and SEC filings instantly, we have to ask what role is left for a human investor. The answer lies in human emotion. AI may process data faster, but it cannot eliminate the panics and bubbles inherent to human nature. The rise of algorithmic trading has actually created new opportunities. These systems use mechanical risk metrics that force selling during downturns, regardless of a company's health. We saw this exact anomaly happen in the semiconductor sector with Micron. The company posted strong numbers, yet the stock dropped because it didn't meet irrationally high market expectations. This chart shows the result. Even as revenue trended upward, the stock price plummeted due to algorithmic pressure. The human advantage today is not mathematical calculation. It is the psychological endurance needed to wait for machines and other humans to panic. The traditional value investor is at risk, not because value is dead, but because they have stopped learning. Deep value intelligence now means mastering the tech stack and waiting for the market to misprice a company's true quality. To access our advanced research and join the community, visit deepvalues.ai. You can track market temperature with the Buffett Indicator iOS app. This video is for research purposes only. Thanks for watching.